Welcome to the last webinar of currency derivatives. If you have any questions through this module, please send them along to us and we will try to answer them. Today's webinar will focus on accounting and taxation of currency derivatives. It will also focus on broker code of conduct and investor protection. Accounting guidelines are carried out or put forth by multiple bodies involved. To understand the pecking order and the involvement of each of these, let's go through in every section. So first of all, ICAI, which is the Chartered Accountancy body in India, right? This body provides a guidance note based on their core expertise around accounting. There are also other standard setting bodies which are global in nature and present in India. These bodies provide their own perspective, looking at, how things are done across the globe on how the accounting should be treated as. Finally, it comes down to the specific regulator for that specific regulated entity type. For example, if it's a bank, it would be an RBI. If it's an insurance company, it's an IRDA. If it's a securities firm or a brokerage firm, then it's a SEBI, so on and so forth. These specific regulators then carve out an accounting framework citing rules by these standard setting organizations, either Indian or international in nature. ICAI came up with revised guidance notes in 2021 for accounting of derivative contracts. The scope of the entities covered include the banking entities, NBFCs, housing finance corporations, and insurance entities. Just by ICAI coming up with guidance notes would not make it enforceable onto these entities to follow these accounting practices. For that, the regulators, which is RBI or IRDAI, need to take action, need to acknowledge and accept that this is how accounting for derivatives needs to be carried out. So while we look at accounting rule making happens at one section of entities which look at focusing on rule making. The regulators focus on enforcing those rules depending on how they find it to be appropriate for the specific entities. So here on the screen is the ICAI's recommendation or the guidance on how accounting for derivatives is to be carried out. So one, ICAI says that it has to be recognized on the balance sheet. What it means is your exposures need to be fairly valued and the exposure sum, either positive or negative, needs to be recognized and put up on the balance sheet as on, whenever you're preparing a balance sheet as on a particular cutoff date. Second, fair value accounting, which means any changes which is happening between two balance sheets getting prepared, getting revised. The treatment of the changes which happen need to flow in through the P&L. So for example, if on a particular date you were in the money and you are showing that as an asset, but on a subsequent date, if you are not in the money and you have made losses, that has to also reflect in the P&L such that the P&L entry then flows into the balance sheet, reversing the entry which was there as on the previous balance sheet date. Third is hedge accounting option. So, a lot of exposure taken is not speculative in nature, but for hedging reasons. Example, I am expecting to make a payment in USD. I would actually get into a currency derivative around USD. If I'm expecting to receive USD, again, I would get into a currency derivative around USD. So depending on whether I'm expecting to receive or pay, I would get into, a future or an option, again, long or short, depending on what I wish to achieve. And since you are hedging against a expected payment, a future payment, you are allowed to look at that on a net basis. So you can cancel out the hedging that you wish to do, and you apportionment of hedging to your open currency positions. That's allowed to be done. But you need to provide, which is step number 5, you need to provide adequate disclosures of how you have netted out the positions. You need to mention that in your footnotes to the balance sheet. Fourth point, which is again, something in between 3 and 5, from a conceptual standpoint as well, is in case you decide to not hedge, or rather, so you might have taken a hedging position, you might be having a business exposure level, but you decide to only selectively or partially consider that for hedging and wish to report both the expected income or expense of foreign currency and the derivative position, then you can also do it on a selective basis, which means you can partially show that yes, I'm hedged on account of these two things, and for other things you basically mention that this is my expected income or expense in foreign currency, and I've also taken a derivative position. So you can take a mixture of showing it entirely as a hedge position or showing a portion of it as a hedge position, and again, adequate disclosures are essential and most important in these cases. The previous slide, we talked about fair value. Let's go a little bit deeper to understand what ICAI means by fair value. So by fair value, uh, this is not really a valuation piece, which is defined as you use a model and come up with a fair value. ICAI, by saying fair value, means this should be the exit price. So an exit price is nothing but the price at which you think this particular derivative will be removed from your balance sheet, will be transferred out, as a liability, or will be transferred out as an asset, whatever you have to receive or pay. That's the exact amount that you're trying to evaluate, which is the exit price. Additionally, in case of futures, the exit price is very much determined based on the trading activity, and you can have a mark to market based on the last trading activity that you have seen. But in case of OTCs, that becomes a bit complicated. So in those cases, one has to evaluate based on judgment, and just in case there's a rogue transaction which happened, you cannot really mark up or mark down your position based on a rogue transaction. A rogue transaction is a transaction which is perhaps not as close to the market situations, and one has to keep into account that when you are selling or buying to nullify the position, just from an exit standpoint, it has to be to a knowledgeable and willingful counterparty, which means just because some party is willing to pick up your derivative or nullify that derivative for you at a particular price does not mean that that is the exit price. Exit price has to be fair, which means it has to be as closely associated to the market as possible. Finally, fair value should also take into account credit risk. For example, there might be counterparties, or there could be people involved within the transaction who are willing to take a much larger risk, and but nonetheless, we are not sure about this counterparty's credit worth or credit scores. In those cases, one has to also account that, okay, there is credit risk also associated and not just market risk. We had discussed about credit risk and market risk in one of our previous webinars. Market risk is the risk associated with the direction of the currency movement, whereas credit risk is associated whether the person would pay up in case there is an expectancy of receipts on account of the derivative. And lastly, extent and availability of collateral is also important for you to have a safe understanding around the risk management and to have the comfort that this position is really worth in fair value terms of what you are keeping it on the balance sheet as.
So I can see a couple of questions on the screen come up. One is from Tamanna around three videos are uploaded on YouTube. So yes, the team will be uploading more in this specific week. Second, Murli, a very, very good question and contextual over here as well. So Murli has a question around IndusInd Bank's losses, which were reported to the tune of 1,500 crores. And those losses were on account of derivatives, and in fact, to be precise, currency derivatives. Now what happened in that, just a quick quick check and share of news is, so IndusInd Bank used to deal in foreign currency in terms of income and expenses. Now for this they used to hedge the positions. Now while they're hedging their positions, there are concepts like netting. There are concepts like, how do you really net? Do you net everything, or do you net only things selectively where you're making a gain? So they were and for other sort of valuation of the other derivative position, are you keeping that as mark to market, or what is the practice that you're using? So within an internal audit for IndusInd Bank, this had come up that there seems to be a discrepancy around how the bank is accounting for foreign currency assets, be it any sort of derivative positions, hedged or unhedged, and foreign currency deposits. So that was a big question mark. And then this came up, on to the bank's MD, and he mentioned that there could be a possibility that previous year's incomes were a bit inflated because the foreign currency exposure, the foreign currency derivative exposure, might have ignored certain valuations, and which might have led to this sort of a floundering while looking at the audit reports. So that was the concern, and that, yes, was around foreign currency derivatives. That's a very good question, Murli. uh, I think so. Melissa, I think you have a question around, whether questions are appearing on the screen or not for the webinars which are put up on YouTube. Yes, the questions are perhaps for the first or the second webinar are not appearing, but I think the tech team has now taken into account that the questions also need to be on the screen, so that when people like you who are looking at the content can make and relate to that content much more easily. So that feedback has been taken, and for the future webinars which are uploaded, you will also see questions which are discussed at the very end also being displayed on the video screen. I think I picked up all the questions. There's no more questions I can see which are outstanding. So let's move on to the second clip.
I talked about hedge accounting briefly, but I think rather than going through these cards, I would simply say that I'll put up across an example for you to understand it better. And what do you mean by hedge accounting? So, say there's an exporter. The exporter would is expected to receive, since he has exported goods, he is expected to receive, say, USD. If he's expected to receive USD, he has currency risk associated to USD. Now, if this person does not wish to hedge, he can simply, while showing it up on the balance sheet, can show that as on this particular date, I have exposure of this much USD, and put it across in a footnote. But as a business, you don't want to take exposure to financial assets. You want to focus on your business. So since USD is expected to be received, to hedge his position, this individual would go short on either futures or options. Now, what does this do? This nullifies the effect of you having a USD exposure. Let's understand how and why. So a short futures or options makes a gain when the USD depreciates or its value goes down. Whereas it makes a loss when oops, loss when the USD appreciates. Now, this particular position is exactly the opposite of his business position, wherein he would make a gain if the USD appreciates, because then he receives the same USD, but when converted into INR, it is worth more. So what this position does entirely over here is known as hedging. And hedging, again, as per ICA guidelines, can be a complete hedge or a partial hedge. And that's basically the framework for hedge accounting based on ICAI. Three types of hedging models. Remember the keywords associated to each one of them in order to get the MCQs correct on the exam. So fair value hedge is for your business operations, raw materials, commodities in terms of your model number one. Cash flow hedge, in terms of accounting models, is for a string of payments or receipts which are expected. So, cash flows, as the word says, it's, recurring in nature. Finally, net investment hedge, as an accounting model, is for, your investments or for the carrying value of your assets. So, hedging also needs to be effective. What we mean by that is hedging should pass certain common measures, which is, first of all, the key terms with the instrument that you are hedging should be overlapping with your exposure limits. Now, to give you an example, one, say you're expected to receive some amount of foreign currency on April 23rd. Your hedging instrument should be such that that coincides or ceases to exist on April 23rd. If the date is plus or minus April 23rd, then in that case, which is basically the day or when you're receiving the money or paying your money in foreign currency, then in that case, you are open to some bit of risk because of the timing, right? Second, your hedging should be offsetting on dollar basis. So if you have an exposure of, say, 500,000 in terms of receipts, then your hedging amount should also be 500,000 and not more or less. But oftentimes, it's difficult to hedge to the exact extent to which your exposure is there. Additionally, at times your hedging cannot be for the same underlying. So you take a close proxy while you're hedging. Example, say you are hedging against, say, a currency which is Thai baht. Now, in case of hedging against Thai baht, you might not get a quote for Thai baht, and hence you pick up another currency which you think is very sort of very strongly linked to Thai baht. So that's where the regression analysis comes in, and you hedge using that currency. So hedging effectiveness, again, to simply put, is are tests to see how your terms to the derivatives contract on the currency relate to the terms uh, for your exposure on the business side. So, derivatives, how they are represented on the financial statements, depends on how they have been classified or have been tagged along for reasons or such as hedging or otherwise. Now, in case of derivatives which are speculative in nature, they are considered to be part of current assets and liabilities. So that would be this specific category of derivatives, and they will be part of your current assets and liabilities. Derivatives which are used for hedging purposes, for assets or liabilities which are yet to come, they would be classified as current or non-current based on the reason for the hedging item, which means if these assets and liabilities are long-term in nature, then these derivatives, which are used for the hedges, will also be considered long term. Likewise, if these assets and liabilities are short term in nature, then in that case, these hedges are also considered to be short term and will be part of current assets and liabilities. A similar rule for forecasted transactions. So, in due course of businesses, a lot of businesses actually continuously import and export, and they do forecasting of transactions. If these transactions are expected to be settled uh, in the longer term frame, then the derivatives are also considered to be non-current in its nature, right? And finally, derivatives, once you prepare any sort of financial statement, it's as on a particular date. And while you prepare the next financial statement, you need to take into account what has changed, what has been the changes in the mark to market of that position, and this particular derivative needs to undergo its sort of treatment through the P&L as well as the cash flow. So these are some ways in which it's part of the balance sheet and how it gets treated on the other financial statements. Right? So that's how derivatives and these recommendations are basically, again, as I mentioned at the very start of this webinar, come from the ICAI.
So I can see one question from Danish. I think Danish has joined in a little later part of the series. So Danish, yes, these recordings for the earlier webinars will also be made available. Currently, there are three which are there on our YouTube channel, and more will be put up through this specific week, expected to be put up through the specific week. And in case you have missed on any of your previous webinars, you can certainly go back and have a look at the recordings put up on YouTube. Bear in mind that the YouTube channel is VWEK FinTech. When you search for that, you should be able to get through that. I don't see any other questions, so we can move ahead onto the third clip, please.
Disclosures are also very much required because they guide the person who's reading a financial statement to understand what and why these derivatives, first of all, have been exercised or have been initiated. So, in terms of disclosures, first thing is one has to tell what is the reason or the rationale for derivatives. We have seen profit margins, EBITDA margins, EBIT margins change just because of derivatives. The reason is, the positions could be hedged or unhedged, and that can move the margins with on the P&L. Now, as we know, a margin change of even 1 or 2% can be very, very detrimental to the stock of the company, and hence it is important to give as much disclosure as possible to the investor or the person who's reading these financial statements to understand why and what has been done around derivatives and what is the call or the basis for that. So for that, the derivatives again, it needs to be mentioned whether this is basically to to manage financial risk, or are the derivatives taken to make monetary gains or financial gains. So that has to be mentioned while you're disclosing. Likewise, the reason is whether it is complete hedge or partial hedge, that also needs to be mentioned. How or what model or practice are you using to determine the value of the derivatives? Because that tells the reader of the financial statement to know uh, the various fallouts, because there might be a particular methodology which might use perhaps a non-sticky price. If you are using a non-sticky price, things are expected to be more volatile in those cases. So your derivative valuation also will be more volatile. But all of that, again, there's no rights and wrongs here, but that has to be disclosed while you're making preparing a financial statement. Likewise, the extent of losses on account of derivatives has to be specifically mentioned so that a reader can get a much granular understanding of what are the profits and losses from the business operations and what are perhaps windfall losses or gains just because of the movement of the currency. Finally, it's advised that proper risk management policies also be in place and those be cited in the financial statements. Again, you don't need to cite the entire risk management policy, but just the framework or the guiding principles are advised. And this consists of all your disclosure requirements for derivatives within your financial statements. Accounting Standard 30 does not specifically say it's pertaining to derivatives, but it reads something like that it has to qualify certain conditions for it to be a financial instrument wherein the specific principle Accounting Standard 13 is to be utilized. So one is, it says that the value should change based on the underlying, which is basically your, the derivative definition itself, wherein it says the value of the derivative relies on the underlying. So that's your, largely coming out from the derivative definition itself. Second, this particular instrument, this financial instrument, you know, for it to be having an application of Accounting Standards 30, should have little or no initial investment. So a derivative position is taken with very little initial investment, and hence it sort of qualifies even point number two. And thirdly, it should be settled on a future date, which is always the case for a derivative position, and hence exchange traded derivative contracts satisfy these conditions laid out in Accounting Standard 30, and hence Accounting Standard 30 becomes the guiding principle for accounting of derivatives as per ICAI. We have talked a lot about accounting. Now let's get into the taxation piece. So from a taxation piece, we are dividing this into two parts, which is one for regular taxpayers and the second one is for foreign portfolio investors. So for regular taxpayers, exchange traded derivatives are taxed as your usual business income. And based on the business that you do, the income or losses basically gets added, as I just pointed out over here. So in case you have losses on exchange traded currency derivatives, your income from your business, that these losses can be deducted from that. For a foreign portfolio investor, two things to note is uh, the P&L from derivative transactions are taxable under capital gains, if positions are for a short-term period, which is within that sort of 12-month parameter, if it is for a short-term period, then these are treated as short-term gains and losses. Otherwise, they are part of capital gains. Now, of course, the percentages here would differ and will be based on the IT Act prevailing at that time. Final slide for accounting and taxation, then we will move into the other section of this webinar. So this specific slide talks about the set of rules. With regards to the set of rules, in case of exchange traded derivatives, since it's treated as normal business loss or income, the loss can first of all be set off against other heads, but it cannot be set off against salary income. So you need to have a business, and then in that case, your losses can be set off against the business income in case you are having losses on the exchange traded currency derivatives. In case your losses are larger than your income through business, then in that case, the losses can be carried forward for up to 8 years. This is the same as your typical IT rules, wherein the losses are allowed to be carried forward for 8 years. And uh, subsequently, the losses can be set off against the business income. Again, some conditions attached to this is you should be filing your returns on or before the due date. So you should not be having a delay in filing the returns for you to set off your losses, set off your unabsorbed losses on exchange traded currency derivatives. And if you are filing your returns after the prescribed date, then the setting off of losses is not allowed. So that's around largely the taxation of exchange traded currency derivatives. Now we move into the final chapter of NISM currency derivatives. It talks about the code of conduct and investor protection. SEBI's code of conduct for brokers puts three different categories on which the broker should take note on. One is the general conduct, which is largely around behavioral traits. This includes, having integrity, using your skill and care while conducting yourself, not to get involved in any sort of manipulation or malpractices, and adherence towards any statutory requirements being posed by the statutory bodies. This is just a general code of conduct, which is more around behavioral traits. There are two specific booklets of information, one around duty to investors and duty to other brokers. Duty to investors covers, maybe if I do just put an overarching point over there, it covers that the investor should be treated fairly, so no front running or things like that. Any information which is material to the broker or to the investor, the broker should basically send that information to the investor. One investor should not know about another investor's information, what is getting traded or what is sort of, the plan and strategy of these investors. And the recommendations which the broker makes to the investor should be suitable for that specific investor. Now, the third bucket around the code of conduct for brokers is for other brokers, and how do you conduct yourself vis-a-vis other brokers. So there should be cooperation with other brokers, allowing them to have a fair level playing field, and not to sort of create cornered plots within the market. This would mean that in case there are any contracts which have gone through bad paperwork, they have to be reported and have to be mentioned to the other broker. The settlement and compliance has to be consistent and cooperative with other brokers, because this entire community works with each other For a buyer, there's also a seller, and behind all of them would be two different brokers. And hence, their understanding on cooperation is very much required for smooth functioning of the markets.
So, Kashinath, the name of the channel is VK FinTech. I'll repeat, which will have all the recordings of the previous webinars as well. You can certainly look at that. And given that we are concluded with our one of the chapters, so we are going to be covering two chapters today. We are concluded with one of the chapters. Let's move into a short quiz, a 4-minute quiz. So, Raj, can you please put up the quiz? So this will be a 4-minute quiz for you guys. It's a 5-question quiz just to see how or whether you have understood each of these questions well. I would request all of you to go through these quiz questions and attempt these, and we'll be looking at the answers and we'll be talking about that in a short while. All right. So I can see that a lot of you appeared for the quiz. Let's go through the questions and answers here. So the first question is guidance notes on accounting for derivatives contract recognizes following type of hedging for hedge accounting. These were the three options. So the answer is all of the above. If you remember on the screen, you had three, sort of cards which talked about three different types of accounting types, and I mentioned about what each one pertains to. This is that specific slide being tested here. The second one, ICAI's with standard. I think we discussed this at large about accounting standard 13 and what it entails and what is the accounting principles around that. But again, you need to remember that is AS 30 because numerically you need to mark the correct answer. So hence it's AS 30. I hope you got it correct. In case you haven't, please remember it is AS 30 which governs accounting for derivatives. Usually, income from exchange traded derivative is treated as business income and it can be set off. As you remember, when we were discussing around taxation, we mentioned that yes, it is treated as business income and it can be set off. In fact, question number 4 talks about, what is it not treated as? It's salary income. And I gave you an example that, you make a gain, or, you have your salary which comes in, and can you set off a derivatives loss against it? And the quick answer was no. So question number 4, the correct answer is C. It is, it can be treated in many ways, but it certainly cannot set off against the salary income. Finally, anyone who's been long enough filing income tax returns knows that 8 years is the maximum limit for you to keep the documentation around all your accounting, to set off all your losses previously. So these were the 5 questions. Quickly, to give you an assessment as to how many people got how many correct. So give me a moment. Let me just have a look at the responses. So the first question, a lot of you people have marked, the highest percentage of people who answered was all of the above. But a lot of you guys have also mentioned option 1, which is not correct. It is all 3. So yeah. Second, I think everyone perhaps remembers AS30, so around 80% of you got it correct. Third, business income. Okay, wow, great. So we have around 90% of you who have got it correct, that it can also be treated as business income. As for fourth, I can see 80% of you got it correct. It is not everything else, but not salary income. It cannot be set off against salary income. And finally, perhaps there are new people on the IT side, or people who are not that aware. Well, 8 years is the typical number of years which you can carry forward your losses, or you are supposed to keep your documentation active and alive for. And from a percentage standpoint, close to 75% of you got it correct. So the questions actually were relatively easier, I felt. But I hope you were able to grasp and relate to the slides which we put up earlier. Now with this, we'll move on to the final chapter. There's a little bit which we have covered. We'll cover a little bit more, and we'll move on to the final quiz for today. So yeah, over to the next clip.
In case the investor is not happy with the services being offered and wishes to complain or put across a grievance, the first route is basically to approach the trading company or the brokers to just cite and confront around what is the issue and try and resolve that. If that's unsatisfactory, then they are supposed to approach the stock exchange where the specific broker or the trading firm is registered. That if that does not work out well, the third level of or the second level of escalation would be to approach SEBI and partake their blessings or have them involved in the grievance settlement process. On the second level of escalation to SEBI, the SEBI has basically created a portal called as Common ODR Portal. This specific portal is not just for the brokers, but for all capital market intermediaries. And in case of any complaints, one can sort of register these complaints there. This portal uses digital tools and takes into account certain timelines by when this has to be resolved. The resolution methods over here harness online conciliation and online arbitration with efficient dispute resolution mechanisms. So the ODR, which is online dispute resolution, is SEBI's platform to resolve for disputes. And as I mentioned on the previous slide, for any intermediary or an investor who's not satisfied, the first level of resolution would lie with confrontation and speaking straight with the entity in question. The second would be with the exchange, and the third one would be with SEBI, and this platform gets used for that resolution. There's a large list of entities that are covered under ODR of SEBI. They are on your screen. Simply put, these are all the entities who are involved in supporting the capital markets, in supporting the securities market, and they wear multiple hats at times. But yeah, they are all part of the ODR framework for dispute resolution by SEBI. ODR process flow begins with the initiation of the complaint. Uh, if this is unresolved, it escalates to the MII or scores. MII refers to market intermediary, infrastructure intermediary. KFIN is one of the market infrastructure intermediaries. Uh, this has to be resolved onto the portal and has to be reviewed by MII. If that fails to happen, it goes to the next stage, which would be conciliation. There is a separate body or individual who would try and mediate between the person who has complained and one of the market intermediaries against which the complaint has come. So this market intermediary, of course, has to be linked to SEBI and is going to be part of the list which I had shown earlier. If that fails, then it moves into the arbitrations or the settlement stage. Now, in this case, the once the amount is put up, saying that this is the claim amount which is under context, the market intermediary has to deposit the entire amount before the start of the arbitration process. Arbitration process begins, and it again has a set of fees which is to be paid for arbitration process. uh, Once this process runs through its course, the award is implemented. Now each of these stages again has timelines associated to it, and that's why this is a strong process, because it will not needlessly drag on the legal affairs forever. And more so, even the cost involved in the process are well aware. The investor is well aware about that, since these are all defined cost and cannot be changed. Just the same way as the clearing corporation has a fund, a clearing corporation guarantee fund, there's also an investor protection fund which is established by the stock exchange to protect client interest when trading members default. So, we'll go deeper into this, but simply put, this is parallel or similar to the settlement guarantee fund set up by the clearing corporation. IPF has several sources for its funding. 1% of the listing fees on the stock exchange, which is received on a quarterly basis, gets put up into this fund. uh, any sort of security deposits received, and the interest which bears on top of that uh, is also credited to the specific fund. Any investment income generated from the existing corpus is also part, or rather, again put back into the IPF. Any penalties charged to the trading members or any of the listed companies for non-compliance, or for whatever reasons, is also added to the investor protection fund. Any transaction charges contributed based on transaction charges by exchange members are again added to the IPF, and it could also constitute of any other contributions as specified by the regulator, which is SEBI. KYC is a mandatory process for customer identification in any financial institution. And while any individual invests into the markets, it's also required that individual, that entity is also required to go through KYC. The verification would entail identifying the individual or the entity, the address, to have a track record for the financial statuses. This, from an individual standpoint, would mean that, have the PAN linked, understand what's the occupation, and any other personal information as prescribed. PAN linkage is the sole identification number for all security market participations because and this is regardless of how big or small the amount in which they transact. The reason is the income tax authorities basically would like to understand the entire money flow and what is the income which this specific investor has made so that the IT can claim tax accordingly. With the advent of the last 10 years over where we have expanded, India as a country has expanded its digital footprint. We now have eKYC, which can be initiated through Aadhaar because Aadhaar in a way has already done several steps, has taken several steps around the core requirements. There's also an e-signing mechanism which has now been put into place, so you don't need to physically sign every document. There is online app-based KYC also, which happens, which gets used by several platform providers, investment platform providers, or for that matter, even brokerage firms. There's a video in-person verification, which means you don't need to walk in and verify yourself the way in which you typically show your identity card on a screen on in front of, and it gets recorded and sort of gets registered and gets verified by someone who's sitting in the back end and having access to these videos would be able to verify you the same way as the individual would verify you in person. And finally there's the DigiLocker, which essentially you can have your soft copy of your documents being part of that, of all your government documents as well as your mark sheets and so many other documents. All of this infrastructure has now been built in India, which assist in quicker and digital conduct of know your customer, which is KYC. We talked about several digital initiatives around KYC which support KYC. There's also something known as central KYC. Now, central KYC is a central government, initiative which falls under the management of CERSAI, which is your Central Registry of Securitization, Asset Reconstruction, and Securities Interest of India. Right now, what they do is they, other than just having the repository of the KYC requirements, there are some additional requirements which have been put into place. And now with CKYC, you don't need to go through KYC again and again for every KYC requirement against market intermediary. What you can do is rely on CKYC, which is central KYC. You might start to see on several documents wherein your CKYC number is starting to being put up. Now this specific initiative is meant to smoothen the process and try to remove the repetitiveness which is required when every individual does KYC with every market participant, or to comply with the KYC requirements. So central KYC helps in eliminating the repetitive work around KYC for these market intermediaries. There's a requirement to categorize clients based on risk. So risk profiler is a requirement to be conducted even by mutual fund distributors when they are distributing SIFs. And they can be bucketed into three categories, which could be low risk clients, medium risk clients, and high risk clients. There should be a set of questions which need to be asked to understand the profiling of this customer, and then there should be a proper grading of these individuals so that any product which is being taken to a client is also being taken after taking into account the appetite on the risk and return. UCC basically captures the relationship between a broker and the investor or the client of the broker. Now, this is a unique number which gets created, and this unique number has to also be linked to the PAN. These details have to be furnished to the stock exchange before initiating any sort of transaction. This is a requirement, and any non-compliance will be put up onto the part of the stockbroker, because they are assisting in placing trades, and the fines will be levied onto the broker in case the UCC details are not provided to the exchanges. This brings us to our last slide for currency derivatives. To summarize this specific slide, SEBI believes that the role of monitoring the capital markets is not only with SEBI, but with all market intermediaries who are registered with them. They expect that any activities relating to money laundering or tax evasion needs to be reported to them under the suspicious transactions reporting. Uh, there are rules to it, there are guidelines to it. They are there on your screen. Post this slide, you'll have 10 questions to attempt against what we have learned today through the hour. Feed in your responses, and I'll be back with you shortly.
So we have already gone through 5 of those, and we'll be going through another 5. Before we go through that, I'll just pick up a few more questions. I can see Dhanesh has put through a few questions. So Dhanesh, first of all, the derivative segment is nothing but, in other words, the F&O segment, futures and option segment. So derivative income is not different from futures and options income. They are used interchangeably. Second, Dhanesh, you have mentioned about whether if derivatives income is part of business income or not. So yes, derivatives income, in case you made losses on derivatives and you have a business income, you can set it off against the business income, in a way reducing your tax liability. Similar way, your derivatives income, the one of the questions on the previous slides was that you can put it together with what other options. It can also be considered to be other income, but it cannot be considered to be set off against salaries. So these are some of the important concepts. Just bear in mind what it can set off against, what it cannot, where it can reflect on your ID statement, and where it can't. With that, we'll move on to the 5 questions. So here we have the responses now. So investors can have grievances against all of these. any which ways. And what I could see in terms of responses is that almost 95% of the audience got it correct. So I think great job there. Second is funds created to take care of legitimate investment claims is basically your investor protection fund. Remember, the settlement guarantee fund is specifically for settlement and not for investor claims, right? These are two different things. Bear in mind. Again, from a response standpoint, I can see that around 85% of you got it correct. So again, I think two good questions for us in that way. At least the audience is well aware. Arbitration is a dash judicial process. Uh, I can see close to 60% of you have got it correct, whereas a lot of people have written non and fully. I have also marked non and fully. Well, see, arbitration is a process which is not 100% judicial because it does not go to the courts. There's no court kacheri, and that's why it's not fully. That's one. Second, if you remember the flow of what needs to be done within an arbitration process of the ODR, wherein you're having your complaints getting resolved, there was one layer which said arbitration, and it had a timeline as well. So it is not fully judicial because it's not relating to courts. It's not related to the judicial system in India. It's a quasi judicial process, right? From an answer standpoint, uh, okay, not that bad. We have close to 75% of you who have got it correct. Fourth question: execution of power of attorney by the client in favor of stockbroker is, of course, optional. You can't force the investor to say that the stockbroker should have power of attorney. Power of attorney is only for select cases wherein the client wants certain activities from the stockbroker to be done without checking on them for specific instructions. Otherwise, you need to have client access and approval for everything. That is not the case. Hence, A and B are certainly wrong. C is optional. Of course, you can have a POA for the client, and the correct answer is C. From a percentage standpoint, 70% have got it correct. So okay, that's not bad. And finally, the broker has to submit the KYC information to the KRA, which is your key record keeping agency. It cannot be SEBI. SEBI does not collect individual information. Likewise, it is not your clearing bank. Clearing bank for no reason is required to have that information. Depository has a different type of information, but not your KYC information. So the correct answer is KRA. And as far as the fifth question is concerned, I can see again 75% of you got it correct. Well, I think this would be it for today. Before moving ahead, I'll just quickly have a look if there are any more questions which are required to be answered. Okay, there's a question from Vijay. Please explain different types, a difference between all type. Uh, I think you're referring to. Can you put it back the screen, Raj? The questions. I think you're referring to. I think you're referring to your. Perhaps I'm just assuming you're Vijay, but I think you're referring to the questions which we have put up here. So all type, all of the above. Perhaps that's the first option I can see. Well, if it just simply says that investors can have a grievance against, what kind of players, and it can be the company, it can be brokers, it can be intermediaries. That's the, it could be with all of them, and hence the answer is all of the above. So I think, Vijay, I hope I answered your query. In case there's something more, just please type in quickly. Uh, Okay, you're talking about the judicial process. So, Vijay, within our video, we had talked about the judicial process. We had talked about, so you're referring to question number, I believe you're referring to question number 3. So, over there, arbitration as a process it's considered quasi. The reason is it is still having its application. It's still enforceable. It is within the framework of the system. But when you use the word judicial and when you say fully judicial, it has to be with the courts. Hence, it is not option number B. It is not option number C. The reason is it's because it's still within the entire process of how things resolve. For example, even in your RERA, which is your Real Estate Regulatory Act, you can have arbitration with the builder, with the developer, and that is still considered a quasi judicial process and not a full judicial process, because a full judicial process similarly has to go to the court. So arbitration as a process is always considered to be quasi judicial and not fully judicial. Same is true for when it comes to investor grievances, and it is enforceable, and hence it cannot be a non judicial process. And option D is none of the above, which is not the case. So arbitration, when you look at it from a judicial standpoint, one thing that should come to my mind is it is enforceable, and hence it's a quasi judicial process. I hope, Vijay, I could answer your question, or at least talk you through about why it is known as a quasi judicial process and why not a fully judicial process or a non judicial process. I think those are all the questions uh, which we had from our side. And we have concluded the currency derivatives module with this. And tomorrow we'll be going live with the equity derivatives module. Look forward to seeing you then. Thank you, everyone. Have a good evening.